That was the week for January 21, 2022. And it's been quite a week. I was away in Costa Rica last week. And as soon as I went away, the stock market started to crash, and it's continued to crash this week. Keith, it's been a dark week for Wall Street, and especially for the big tech companies on Wall Street. I saw today, I think Netflix has dropped, 40% in a couple of months.
Yeah.
And the market's dramatically down. What's going on?
Well, what's going on is what is known as compressed multiples. How does that
You
sound?
wanted to get that in. You told me to get it in, and you got it in early.
Compressed
Good
multiples.
job. Compressed multiples. What does that mean?
Well, the way the valuations work with stocks, not many people realize this, and it's very simple and easy to remember once you realize it. It's how much are you making in revenue? How fast is that growing year over year? And what multiple of this year's revenue or next year's revenue are you trading at? And recently, companies that have IPO'd, people like Snowflake, have been trading at multiples between 70 and 100 times their revenues because they're growing really fast, 300-400% a year. And that's what's changed. Suddenly the market said, that's crazy. We're only going to give you the mean multiple is about 10 times revenue.
And this always happens, Keith. There's always irrational exuberance. People are always buying the future. They're saying, well, we're willing to give those multiples because we know these companies are going to grow. And then suddenly there's a time of reckoning. Why this week? Or why has 2022 been such a dramatically bad year so far for public big tech stock?
Yeah, I don't think there's a single reason. I think you can list a bunch of reasons. The first is the Fed is saying it's going to increase interest rates 3 times this year.
That was fairly inevitable. I mean, that's no great surprise, is it?
Yeah, but if you're an asset manager, the price of money goes up. If interest rates go up. So money is a commodity, just like a washing machine, and it has a price. And if the interest rates represent that price, so if they're going up, then it's less and less attractive to put your money into risky things because you can make a yield without doing risky things. So,
I like the washing machine metaphor. Maybe we'd be better off putting our money into washing machines, quite literally.
Dishwashers, I think. Mine broke this week. I have to buy a new one, if that's a common experience. And so it's compressed multiples. However, it isn't evenly distributed. So you talked about Netflix. This is Peloton, which is also, this is yesterday. It's even worse today. But Peloton went up to $160 something at the peak. Yesterday it was at $24. And so you've got. But
isn't Peloton a classic stock? There's always a stock like Peloton that's always been ridiculously overvalued, particularly in COVID. And suddenly it's just coming down to reality.
Well, that's the second thing after interest rates. It's the supposed end of the pandemic and the start of the endemic, meaning that we're going to learn to live with stuff. And therefore, all of the pandemic stocks, Netflix is one of them as well, have suffered disproportionately.
Is that like endemic, how you and I have learned to live together on this show?
That's a pretty good example. I mean, we both tried to use our antibodies against each other initially.
And we realized we couldn't win, so we made peace.
That's like me and my teenage boys. When I realized I couldn't win.
So when is this all going to stop, Keith? Not tomorrow, because the markets are shut. Next week?
It's. I would think it's getting towards the end. It hasn't just been a week or 2 weeks. It's been about 2 months, actually.
And it's a healthy bloodletting. I mean, these guys, the serious people on Wall Street know exactly what they're doing, don't they?
Well, they're
letting the air out slowly. Well, not so slowly, but in a way that won't result in a complete crash.
I always find it interesting because the wisdom that people like you and me get is don't sell when the market goes down. But clearly, that isn't what the big guys are doing, because it goes down when there's no buyers.
Yeah,
That's the
but
way it
they're
works.
buying and selling. I mean, they know
Well, there's
exactly what they're
the
doing.
middle.
I found your editorial good this week. Your editorial, of course, Keith, is always good, but particularly good this week, talking about your sons.
Yeah.
And there is this generation that assumed that the market was always going to go up. It was like the cab drivers at the end of the 90s. We'd had that conversation last year, and I had suggested that at some point this thing is going to burst and that a lot of people are going to be very unhappy. How are your sons dealing with this?
Funnily enough, I wrote the editorial yesterday, assuming that they'd be in great pain. And at dinner last night, I said, "Oh, I wrote about you guys today. How's your Robin Hood doing?" And I expected that they'd open it up and kind of scream, not having looked at it for 2 months. But they looked at it. They were a little bit concerned, but then they said, "Well, I bought Dogecoin when it was 7 cents. It's still 15, so I'm still up 100%." So actually, they weren't in as much pain as I assumed they would
Like
be.
father, like son, you make the same point in your editorial that whilst you're feeling the pain of the public market crash, you're still up over 100%. And the other point you make in the editorial this week, which I think is really interesting, is it is a tale of two markets, because on the one hand, of course, we have the crash of the public markets, but the private markets and the venture business, which you now are part of, is really hot,
Yeah,
remains very, very hot. There's no crash there.
yeah, they're very different markets, and also the M&A market. I mean, Microsoft bought Activision this week for 70 billion, and so there's a lot going on in M&A, and there's a lot going on in the private markets. In the private markets, the price being paid for revenue, again back to the multiples, is between 1 and 400 times revenue for early stage companies that are growing fast, and that
You
will
mean
go
between
down.
100 and 400, not between 1 and
Yeah,
400,
between 100 and 400. And
which is normal, isn't it? I mean, when you invest in an early stage company, they don't have much revenue.
well, when you first invest, it's infinity because they haven't got any
Yeah.
revenue, and then they get to revenue. And in the last year or so, the competition to invest in companies has driven the multiples higher and higher. One of my portfolio companies today, which I won't name, is doing around about 12 million a year in revenue, and he asked me what should be the valuation on the next round, and I gave him a table which on the low end was 20 times 12, in the middle was 50 times 12, and at the top end was 100 times 12.
But there is a lag here. You're going to tell me that there's always a tale of two markets, which you may be right. And there have been a series of articles this week. I don't know if you have them all in the newsletter, suggesting how much stronger the venture market is than the public market. But it can't go on forever. How will the other market be affected by the downturn in the public market?
Funnily enough, it's almost the opposite. The trend that's been locked in for about 10 years now is that companies only go public when they're very mature. So what that means is if you're putting a value on growth, most of the growth in value happens while a company is still private. And so money that used to be dedicated only to the post-IPO phase has been forced to come backwards to the earlier phase. And in fact, venture money, which used to be only for the growth stage, is starting to come backwards to the
But
Series A.
if all somebody did was watch this show and particularly listen to you, they would assume there's a huge bloodletting in the venture community, that
Yeah,
the
no, not at
Tiger
all.
Globals of the world are controlling most of the market. The middle market is disappearing, and you have a
Yeah.
long tail of investment. But that doesn't seem to be happening.
No, that is happening. I mean, if you look at, I looked today at the last 12 months Series B financings, the first 178 of them, the financing raised more than $100 million. So the check writing can only be done by very large allocators of capital like Tiger Global and SoftBank and the others. So if you're I talked to one of my investors yesterday who told me that he's invested in a seed fund, and that seed fund has a company that is now doing an A round at $500 million valuation, probably raising around 100 at the A round. So what's happening is there's less and less deals, but greater and greater check sizes. And so the middle of the market can't compete, so it's forced to go earlier. Now, at the same time, Y Combinator, which is early, is starting to go later. And so there's a compression going on between the seed stages.
What's the phrase you use? What's the technical term for this?
I don't actually have a technical term for this.
Well, this was the term you used at the beginning.
Compressed multiples. Yeah. But this is actually the opposite. This is the multiples are getting higher because the competition to invest in the best startups is so intense that people are paying earlier than they should.
One thing I guarantee you, and I'll say this publicly, is that at some point there will be a dramatic correction in this market as well. I don't know how or when, but it will happen because nothing ever goes up forever. And this market is not immune from the same market fluctuations and the drama and the irrational exuberance of the public markets.
Well, that is what Thomas Tungers writes about in the article that headlines this week. If I click on it, it'll open up and people will be able to see it. But he makes the point that there's been a 52% correction in the stock market, and that's measuring this multiple of revenues. It's showing how the 75th percentile, he's called it the forward multiple, has fallen from 32 to 14.9. And he makes the point that Series D rounds, which are the private companies, every time there's been a correction, and if people can see these orange bars, those are corrections. You can see how the multiple goes down, but only briefly. So the venture market it is impacted. This is the Series D, by the way. He goes on to make the point that the Series A, there's no impact. This is Series A. Corrections in the orange. The bold line shows keeps going up even through the correction. So the A round.
But if you did that in the late 90s, early 2000s, there'd be a dramatic dip.
Yeah. But that was a one-off. That was when
I don't know about one.
Do you remember how much percentage of its value Amazon lost in that crash?
95%.
98. And it had money in the bank.
And of course, we all bought Amazon stock then, didn't we, Keith?
No.
Me neither.
In those days, I wasn't buying stocks. I was chewing my own.
If I had, I wouldn't be on this show. I'd be I'd still be in Costa Rica.
But anyway, Andrew, you're right that the venture market is impacted, but in a kind of a dulled way, not as dramatic as the public markets.
And I think there was a piece in the Times about if you do have capital, what it suggests you is you're much better off parking that capital in a venture firm or a fund than in the public markets. I mean,
well, it's strange. There's a whole theory, and Berkshire Hathaway came out of this. There's a whole theory that indexes beat stock picking. And the evidence that's usually called to bear there is that the S&P 500 almost always outperforms any individual manager. And I think that remains true. In general, that remains true, which means that passive investing, which is what a lot of pension funds do, is way better than self-directed investing.
Yeah, which is, I'm pleased about that because I'm the ultimate passive investor. What about crypto, Keith? How is this playing out in Web3 in this radical, sharp, painful correction at the beginning of 2022?
Well, when I missed you last week, I did a whole spiel about a Web3 and how it differs from Web 1 and Web 2. And this week, the fight between the various contending advocates has not dissipated at all. Scott Galloway, which I'm sorry to say wrote, almost a plagiaristic piece, very close to what Tim O'Reilly had written previously, saying what a sham Web3 was and picking up on some of the themes that Moxie Millen Spike or whatever it was called.
Marlin Spike.
And then there's
named after a building from the Tintin books.
There you go. And then there's a rebuttal to him. There's the New York Times talking. This is interesting. The New York Times is almost talking as a Web3 advocate, saying the fight between Dorsey and Andreessen puts Web3 at risk, almost as if they're concerned.
Well, actually, but I think you misunderstood my question. What's happening with crypto in this radical downturn? How the Bitcoin prices have fallen dramatically.
They've fallen, but they're still,
So
they're still up 100%.
In terms of Web3, the tale of two markets, Web3 is doing better than the public markets. And crypto's doing better than the public markets, even if there are lots of now crypto investments in the public markets.
Yeah, not so many, but yes, there are some. I mean, crypto in a way is, like the United States circa 1939. That is to say, no matter what's going on in the world, even a world war, investment piles in because the future is always a good place to be. And so crypto is the future. And in that sense, money is piling in. I mean, really piling in. One of the big crypto...
Yeah, you have some interesting pieces on that about how money's piling in and why it's piling in.
Yeah, like Andreessen Horowitz's next fund for crypto, just its crypto fund, is going to be $4.5 billion. The last one was $2 billion. They started off a few years ago at 200 million. So it's just getting bigger and bigger and bigger, their commitment to it. On the other hand, interestingly enough, Benchmark Capital, Sarah Tavel, says it's too early to invest in Web3, that people are going to lose their shirts because it isn't yet clear, where the winning bets are going to be made. So it's best to be on the sidelines. That's probably a bit of a caricature of what she's doing.
Yeah, I mean, it's always too early until it's too late, and timing is everything. You mentioned 1939, which of course brings to mind the Europe of 1939. But your great wife, Sinead Tier, has a piece on Europe, not of 1939, but of 2022, suggesting that it is hot in Europe, not just in geographical terms, but in business terms, which is surprising because Europe's often dismissed.
Yeah. So venture in Europe grew 100% 2021 over 2020. Now, what's interesting, if we click on her article and look at the graph, is who the investors are. SoftBank, Tiger Global, Goldman Sachs, General Atlantic, SoftBank again, Coatue, Sequoia Capital, Insight Partners, Target Global, EQT, Fidelity, DST, and Index. Only one of those is European. EQT.
Fascinating, yeah. So it's a sort of form of kind of almost financial colonialism that outside funds from Europe, from Asia and the United States are investing in European startups.
Yeah, and she breaks it down very well. There's a sister article from PitchBook. I'm sure are intense competitors with Crunchbase, that covers the same ground but doesn't focus so much on where the money's come from, but looks more at the volume of deals. But Europe's typically been the laggard in venture. You've had America first, China second, and catching up fast, and then you've had Europe third, and India was even coming into third place and pushing Europe into fourth. But Europe's caught up, and it's an exciting time to be in venture in Europe, I think. Almost every venture fund of any size is hiring in Europe now, and the Financial Times reports that they're all struggling to find talent. So if you are European talent in the venture space, go and look at who's looking for you and knock on their door.
What about the startup of the week, Keith? What is our startup for January 21st, 2022?
Well, the startup of the week is a 22-year-old Indonesian gentleman who decided to take his daily selfies, which any of us who have teenagers know that teenagers take pictures of themselves all the time. He was doing his daily selfies in Indonesia, and he decided to put them all together and list them as an NFT, as a joke. And in Indonesia, he's called Sultan Gustaf Al Ghazali. A well-known celebrity in Indonesia talked about his NFTs, and they suddenly took off. And in a very short period of time, he sold $1.2 million worth of his selfies as NFTs, and he's now a millionaire. And
$1 million can buy you a lot in Malaysia.
Indonesia.
There's even more in Indonesia.
Even more in Indonesia. So I think he's a well-merited startup of the week. The accidental joke that turned into money, a bit like Dogecoin.
Those aren't really startups, though. You just basically won the lottery and you didn't even buy a ticket.
Exactly.
And what about tweet of the week? I have a feeling that we have someone we know so well coming back onto the show.
So this is Rob Go from NextView Ventures retweeting with the words "insanely impressive" Paul Graham's tweet.
Oh, your hero, Keith. Paul Graham.
So Paul Graham says,
I knew you'd get him back in this show.
Well, this is our chance to have a go at Paul, because Paul is championing the fact that in 2021, an extraordinary 10 Y Combinator companies went public. However, if we to go and look at the performance of those companies since they went public, it would not be pretty.
Come on then, let's see them. What are they? Who are the 10?
I don't know. Should we go look?
Let's look.
He's got a link. So the year in review, we click on the year in review. He mentions Crunchbase. My wife will be very pleased. So Coinbase. Let's look at Coinbase. We'll go to Google Finance. We will type in Coinbase. We will zoom out 6 months, and it is under its IPO price. It's at $191 now, and when it went public, it was $226. Now, that said, and this is...
meanwhile, its CEO, Brian Armstrong, bought a house for $120 million in LA. So,
well, that goes back to my editorial this week, and actually to the meaning of this video. Paul Graham's colleagues at Y Combinator invested when the share price was probably under $1 a share. Yeah. By the time it went public, it was at $226.
So and they probably all sold when it went public.
Well, they don't have to, because even at $191, they've made a massive multiple. And this is why investing in private markets makes sense. However,
yeah, but that's all very well. But you don't. I mean, most private companies, even of the top investors like Paul Graham, they still go bust. So it's not like everyone.
But imagine if Y Combinator was publicly listed and you could buy its shares so that you sailed on its success. So you as a private investor bought Y Combinator shares.
But why would I mean, this comes back to a conversation we've been having. Why would Y Combinator want the aggravation of the transparency? They're doing very well as a private company. They're not looking for funds.
Well,
I'm sure.
Yeah.
All Paul Graham needs to do is pick up the phone, and he can raise as much money as he wants.
Well, from a self-interested point of view, of course, you're right. But from a societal point of view, wouldn't it be great if innovation and growth happening whilst companies are private was available for everyone to share in through some kind of filtering mechanism? So you weren't having to invest in startups yourself, because how would you judge good ones versus bad ones? But you were able to invest in all of those people that are good at that through their shares. So it feels to me as if the venture ecosystem, which is basically a medieval system, like an artisanal system where experts in dark rooms make decisions. If you could turn that medieval system into something that society benefits from through ownership, that would be a good thing. And I do think it's possible, although the SEC makes it really, really hard because they don't want normal people owning private stocks. in their view, to protect them from failure. But there's ways to protect people from failure other than.
Yeah, I can think of another good way of doing this: simply make Paul Graham pay 50 or 80% tax, and then on his wealth, and that's another way of redistributing the money. But that's another conversation, Keith. That was the week for January 21st, 2022. I hope next week the markets will have at least stabilized. There'll be lots more talk, I'm sure, of Web3, of Bitcoin and blockchain, all sorts of things. And no doubt Paul Graham, Keith, will figure out a way to
shoehorn him in.
Yeah, shoehorn him in to make him again the subject of our conversation. So have a good week, Keith, and we'll talk again next week, January 28th, 2022.
We certainly will. Bye, everyone.